I think it's time to start. Welcome to the second session of the day on inflation expectations. We have 3 exciting papers on the program, and we will start with Guido Ascari.
Okay. Thank you very much. So thank you very much to the organizer for inviting me and having us on the program. This is a joint work with Paolo Bonomolo, who is sitting in the audience, and Alessandro Celani. And if you have any difficult question, Paolo will be ready to answer. Okay, so the title is The Macroeconomic Effects of Inflation Expectation, the Distribution Matters. And this is somewhat related to the keynote talk that we just, a fantastic keynote talk that by Christian. And I will explain why. So what we are after in terms of research question are the following ones. What are the macroeconomic effects of shocks to the short-term inflation expectation distribution? So we're looking at short-term inflation expectations, but in particular, we want to look at the distribution themselves. So let me start from the very beginning. Here, as I will explain also, spend a little bit later on, we are taking a very different perspective from the literature. There is an enormous literature on inflation expectations. We have seen it, in the morning. We will see it even more today. And normally, this literature asks what are the determinants of inflation expectations, how inflation expectations are formed, and so on and so forth. And the keynote talk by Christian instead is asking about how, for example, macro affects inflation expectation and inflation expectation distribution. In particular, she was able also to link to characteristic of the singularity. Here instead, we kind of flip the coin and we say, okay, let's assume that inflation expectations are at least partly subject to exogenous shocks. One thing that we think we learn from this literature is that so let's move it here, is that expectations are volatile and might be subject to exogenous shocks that partly not rational. We don't know where they're coming from. So I think it's a good question that I think is a bit overlooked in the literature. Of course, the other question is also pivotal and very important. But a question is, if expectation changes by exogenous reasons, does this have any macro effect? And I think that having been in the central banking for a few years now, I think this is also the way, and I was surprised at the beginning, how policymaker thinks about this. Because when you read these speeches or talk to them, they think that they need to discipline expectation, that these expectations are running somewhere, and they have to do something to control them. Of course, in a rational expectation world, this thing would not make sense. You just do what you have to do, you say what you have to say, and the expectation will discipline themselves. The other thing is that what we learn, again, from this inflation expectation literature is that when you have these randomized trials and you solicit with some signal, then agents do act. They change their consumer behavior. They change their investment, employment behavior. There's a paper by Tiziano with Kobiango-Landichenko, for example, showing that. There's a paper by a colleague at the DNB, again, with Olli and Yuri showing about that on consumers. So it seems that actually these shocks do have economic consequences that therefore can affect macro shocks. We also touch, obviously, on this literature on expectational shock in general. There's another literature that has been burgeoning about, sentiment shocks by Angeletos and others. All the literature by Baudry and Potrier about expectational shock and the effects of expectational shock, which are exogenous shocks to expectations, and how this is going to affect macro. So, as I said, we take a macroeconomic perspective by assessing what are the macroeconomic effects of an exogenous change of short-term inflation expectations. And surprisingly, there's not much. I think there's a literature, and I think I quote here just one paper, which is one of the first by Fabio Milani, which is an NK model with learning everywhere, and there are shocks to the learning process. And then he's looking at the shocks. Then there is a literature on de-anchoring. That's slightly different because usually this looks at long-term inflation expectation when we talk about the anchoring. Here, just a few papers looking at that. There is a paper by Truly Yours and some others that look at recently in the JME at the effects of a shock that increase short-term expectation in the average, so the average of this expectation. And we show that this is stagflationary. Actually, this is a paper that I presented at the same conference, I think, in Cleveland a few years ago. So here we want to take a step further. Instead of looking just at the median or the mean of this expectation, we're going to look at the full distribution. And I think, at least on my side, the paper that kind of elicited this question to me was a paper by Ricardo Reis in the Brookings, showing that how the distribution of inflation expectation actually was very important for the episode of high inflation in the 70s. And one thing that comes out from that paper is that it is possible there is a lot of information in the distribution of inflation expectations, and in particular in the tails. And that's basically what we're going to try to assess. So how do we do that? And that's how I think our paper is somewhat related to the paper presented by Christian. So we have met a parsimonious monetary policy BVAR with the distribution of short-term inflation expectation to investigate, as I said, the macroeconomic effects of changes in this distribution. We want to account for the full heterogeneity in beliefs. We want to understand if it's expectation that influence macro or macro that influence expectation, and that's the question of Paolo from before from the audience. And then we're gonna, and that's where the fun is. I had a lot of fun in doing this paper, because then you can think about shocking this distribution. Of course, the distribution is an object that you can shock it in many different ways, and you tell me how you want to shock it. We can try to shock it. Okay? So what are the results? The results is that expectations affect macro variables quite a lot, while vice versa is not very much. So not very little vice versa. Distribution matters because models that are based just on consensus estimates, let's say on the mean or even the mean and variance, tends to underestimate the effects of expectation shocks on macro variables. What we find is that mean and variance shocks are stagflationary, and tail shocks too, or even recessionary, in the sense that prices at the beginning go down too. And the tail matters, and in particular, the tail that matters is the left one. Then we do some, if I have time, I will talk about how we can think about communication shocks or communication in this framework. And the main message, if I don't get there, is that it might be more important to reduce dispersion in this inflation distribution rather than moving the average to the target, let's say, towards 2%. Okay, methodology and empirical model. So what's the problem here? It's a problem similar to what Christian was talking about previously. We faced the problem of incorporating a distribution into a linear VR, right? So how do we do that? There are some papers that do that in the literature. And what we do, we employ a simple multi-step approach. And we kind of discretize this distribution. And we can use either raw data. And that's important because if you look at this survey, this was also evident in one of the graph that Christian shows about the 3D graph with the distributions. These guys tend to, these are Michigan survey, okay, so these are consumers. These guys tend to report round numbers, 1, 5, 3, 10, right? So there's nothing in the middle. So a previous version of this paper used quantiles. But then we decided actually to do rounding exactly because quantiles moves maybe a bit too much that problem. So we use a continuous kernel approximation, or otherwise as a benchmark, a parsimonian-Gaussian distribution. So these are the data, just to show you this. So these are, as I told you before, this guy basically report only integers. So this is the mean proportion of the data. So that's the discrete distribution. That's the red one, which is also can be approximated by a kernel, and that's the blue one. And you can see there's a lot of marks, for example, on 10. And the other one is the Gaussian as a benchmark that's been used often in the literature. And you can see that the Gaussian is not a good approximation of the data. Okay, that's kind of obvious. So how do we do that? Well, we replace discrete and kernel distribution with the cumulative probability. So we define intervals basically by discretizing the distribution. The interval selection is completely data-driven, so they should obey some basic criteria. So they should contain an average large amount of probability mass. The last interval is wide enough to guarantee that the sum is 1, and the largest number of intervals, in particular, such that the median is distinct between all these intervals. Okay. And therefore, at the end of the day, we selected 9 intervals, which at the end are 9 time series. So this is the proportion of people that reported the numbers below -1. This is between 0 and -1, and this is 1, and so on and so forth. Okay, and you can see actually some, I mean, I don't have time to dig into it, but you can see, for example, in times of crisis, right, the proportion of these middle guys kind of tend to go down, while the proportion of the extreme tend to go up, as you can see here. So that means that during times of crisis, kind of the dispersion increases of this inflation distribution. Then we're done. We have these 9 aggregate proportions, and we can build our VAR. So our VAR is built like this. There is an expectation block in which we have this 9 time series plus sentiment. And that's because the Michigan survey, they also report sentiment. And then it's difficult to understand if it's sentiment or inflation. So we treat them as one single block with therefore 10 shocks. There is a macroeconomic block in which we have the consumer price index, industrial production federal funds rate, the standard. We control for real world price and 3 measures of uncertainty, 2 measures of uncertainty, solely financial and macroeconomic uncertainty as from Jurado. And we have a battery of robustness on that. So we model the VR like this. We model in deviation for steady state alla Villani, and we have monthly data from 83 to 2019 for a total of 422 observations. Why we use consumers? Because we want a distribution. So on average, we have 500 respondents from minimum 500 to maximum 1,500. We cannot use really SPF, which has only 30 people. Okay, so that's the main thing. So identification. How do I identify? We identify shocks to the expectation block. So it's a timing identification. So households are going to fill the questionnaire on the 3rd week of the month. So that basically means they do not observe the monthly inflation, interest rate, or industrial production. So they don't know the data about the macro variables. So we're going to assume that on impact, the macro variables does not affect expectation because of the timing assumption. On the other hand, since we know, as has been discussed today, that actually oil price is a very salient price, it's very much related to gasoline, and people do observe that when they fill the tank. This is actually endogenous to expectations, also as a control, and the same for the uncertainty measures. So basically, the block is like this. So you have that uncertainty and oil price are first. So the shock affects all the others. A shocks to the expectation blocks does not affect oil price and uncertainty. And a shock to all the other macro variables does not affect the expectation block. Okay, so that's the important thing is that this block, if this block recursive structure, people might question that. So we have a extensive robustness check, making endogenous first only the interest rate, because you say, they get a mortgage, so they observe the interest rate. And also we have a robustness basically reverting the complete block structure. And the results go through almost quantitatively the same. Okay, so everything I would say is not depending on the identification, if we do believe that this is a good identification. So for the rest of the talk, I will go on with this. Results. Am I doing with time, Damjan? Okay, good. So that's the steady state distribution. So these are the 3 approximate distributions. So that's the discrete, the red one, that's the kernel, that's the blue, and this is the Gaussian. what we're gonna, so the first results, we're looking at the forecast error variance decomposition. And what you can see here, so that is how much of the expectation block variance decomposition is explained by the macro variables, CPI, industrial production interest rate. And you can see that is not much. We have 9 lines here because these are the 9 time series that I show you about. So there's a different, point of the distribution of inflation expectations. So the right tail, so the red dash line are the guys that have high inflation expectations, and the left tail are the guys that have low inflation expectations. Uncertainty and oil prices instead do explain a bunch of this first error variance decomposition. So first of all, it seems that expectations are barely affected by macroeconomic shocks. And by the way, this is also true if you look at the lagged coefficient in the VR. Okay, they are almost 0 for the, and this do not depend on identification. The second thing is that if you look at the forecast error variance decomposition of the macro variables, exogenous variation expectations do affect the macro variables quite a lot. That's the blue area. And you can see that they can explain quite a lot, especially longer rhinos, of the forecast error decomposition, variance decomposition of consumer price index and industrial production. If you do a Gaussian, if you use just a Gaussian instead of using either the kernel or the discrete, you're going to miss that big time. So that is going to be the variance explained by the expectation block of the macro variables for variance forecast error. And you can see that if you use a Gaussian approximation, you're going to underestimate it quite a lot. So now we look at the density impulse response function, something that actually Christian talked about. So what we can do now, we have these 10 shocks, and we can move the shocks and do any. Of course, there are 10 shocks because there's also sentiment. So we're going to apply Antolin Diaz's kind of methodology to show the 10, to select the 10 most likely shocks that may induce the movements we are interested in. So that's a mean shock. So that's a location shock. So that's the baseline distribution. That's the dashed blue line. And we shock it, we move it to the right. Okay, so that's an increase in the mean of inflation expectation distribution without changing the shape in the kernel and in the discrete case. So let's look first at the left here. So here we have the Gaussian and the kernel. And you can see what are the effects of an increase in the median inflation expectation. Consumer sentiment goes down, and with that, industrial production and consumer price index goes down. So this is a stagflationary shock, right? So in which, consumer prices goes up. This is a stagflationary shock in which industrial production goes down and inflation goes up, following an increase in the median inflation, or the mean of inflation expectation distribution. If you are going to use the Gaussian, then there will be the gray line. You can see you're going to you find the same results qualitatively, but quantitatively you're going to underestimate the results quite big time and significantly so. On the right-hand side, instead, you have the same kind of experiment looking at the kernel and the discrete. And you can see that you find pretty much the same. The only thing that, as expected, the discrete has a lot of, the bands are much bigger simply because of the nature of the data, right? It's because the discrete approximation obviously had much higher variance. So what we're going to do, we're going to proceed with the kernel from now on. Or that's, we choose kernel as our baseline characterization. So then, as I said, you can look at dispersion shock, but dispersion, is a very general concept, and there are countless ways to do it. So you should tell me what you want to show. Joke. So you can have a variance shock, right? And then you just, stretch the distribution out. You can have kurtosis shock. You can have skewness shock. So the only thing I'm going to show you, so if you're interested, you can look at the paper. For sake of time, I'm going to show you a tail shock. And in particular, I'm going to show a tail asymmetric shock, because of course you can also do any sorts of asymmetric shock. You can increase the variance by increase the variance only of the right of the distribution or of the left of the distribution. Or a tail shock means that basically you take the tails and you stretch them out. Okay? So that's what we mean by a tail shock. So that's a symmetric tail shock. So you take the tail of the distribution and you put this mass basically on the tail and this mass here on the tail. And you can do it even by doing only on the left or only on the right tail. Okay, so we're going to look at the symmetric and the asymmetric case. So the tail shock, let's look first at the symmetric case. So that's the black line. Again, sentiment is going to drop like crazy. So that's, but that's also in line with the literature. We know that these guys, consumers, when they see inflation that goes up, this is bad times. This is, there's plenty of paper that shows that for consumer, this simply signal bad times. Sentiment goes down, and through sentiment, industrial production is going to fall quite a lot, and also prices are going to fall. So this is a shock, which is little at the beginning, is recessionary, and eventually will become stagflation if you want, because eventually prices are going to go up. So let's look at the asymmetric case. If you look at the left tail, so that case here, you can see that the left tail reproduce almost exactly the same results, while the right, nothing happens, or very little happens to sentiment and to the consumer price index, and just production actually going the other way around. So all the movements in the symmetric case comes from the left tail. So the left tail is the one that matters in producing these results. And you might wonder, okay, with the left tail are crazy guys. They tell us -10, -20, right? So, and indeed, we look at the characteristic of these guys, because we can look at, and apparently these guys are relatively more educated. They have relatively higher income than the other guys. Okay, so these guys on the left tail are the ones that have capacity to spend. And maybe from their point of view, this is not too surprising. So the left tail is actually the one that matters. That's one thing that you should take home. So what are the main policy implications? So if with the 2 minutes, this is kind of a heroic thing, but let's assume that you can move the distribution by talking the distribution of consumers' expectations, even if we know that consumers don't listen to us. If they listen, it's not clear that they understand us, and if they understand us, it's not clear that they follow as we think that they should, right? So, in a sense, this is a very heroic scenario. But so we do 3 scenarios. So the first one, we just perturb the steady-state distribution with the ideal distribution. That's a distribution which is Gaussian, centered on 2, exactly as you would like. The second one is simply a location shock that we have already seen. So we just move the distribution. We center now to 2%, but we don't change, don't touch the dispersion. The third one instead is a kind of mumbling kind of communication in which you are able to just center at 2%, but actually you confuse people such that the tail becomes even bigger, right? So that the distribution becomes much more dispersed. And that's a generalized normal. So what do we find? And with that, I'm finished. Damjan is becoming nervous. So you can see here that you have the normal, okay? So the normal, that's good news. So industrial production goes up, consumer price index goes down, sentiment goes up, all right? So if you're able to do this, good, thumb up, okay? But if you do the location, we already know, you go quite, we already know, because that's a location shock that I already showed you. So industrial production goes up, prices goes down, but not as much as in the blue. That means that actually there's a value added not only in changing the mean, but also try to shrink the distribution and make the distribution kind of less dispersed on the mean. And then look at the third case in which you are able to do the location, but to move the mean, but dispersion actually increases. Well, then you're doing real damage, because industrial production is going down, sentiment is going to tumbling. Sentiment is really skyrocketing down. Industrial production is negative, and the consumer price index actually goes up for a while, right? So that's the message from this graph. I think is that it's much more, or can be even more important to, convince people that, of not disagree too much, rather than locate to 2%. And in particular, again, here is the left tail. So if you want to go out, you have to go out, convince people that inflation is not going to be 0, or it's not going to be -1, or 0 or 1, right? But these are things that, because the left tail is what matters, the left tail is the one that you want to kill. Okay, I think I'm out of time. So we have proposed, I think, a very simple, and in particular, something that it's easy to, I think, interpret, because it's difficult, no? For example, there is this paper by Pfajfar, others looking very sophisticated, putting non-linear approximation of using non-linear approximation distribution, but this is very difficult to interpret. I think this 9-time series in which we approximate the distribution very easy to interpret. And then, you can do a bunch of experiment, and we find that household inflation expectation do affect macro variables, while the opposite is not clear that it's true, or at least we don't find much evidence for that. A positive and dispersion shock is stagflationary, and a tail shock too, even recessionary, and the left tail is the one that matters the most. Thank you very much for your attention.
Thank you very much, Guido. Michael Ehrmann will do the discussion.
Yeah, thanks a lot. Thanks for having me. It's great to be back here. Already on. Okay, here we go. So slides up. Thanks for picking me. This is a super interesting paper. I really enjoyed reading it, and I also anticipated that Guido would do a great presentation. So I don't spend a lot of slides summarizing the paper for you. I hope you all got the message. I'll just repeat 2 or 3 parts of the message that I'll pick up upon afterwards. So, I mean, there's the augmented monetary policy PIVA with the Michigan survey heterogeneous inflation expectations. We see inflation expectations react little to macro developments. In contrast to the other way around, the macroeconomy reacts substantially to inflation expectations. And here the point really is we need to look at the entire distribution. And then there's this very interesting asymmetry with respect to the tails. Okay, so shocks to the left are much more important than shocks to the right. So the people with the low inflation expectations, these are the people we need to look on. And then the paper draws conclusions for central bank communication. Again, focus on the tails, given how important they are. This is much more effective than anchoring the mean. So my overall take is, this is really a pleasure to read. It's very well written. I think it's a super interesting question. It's very well executed. So I learned a lot, and I find the results thought-provoking. So that's always nice if you're a discussant of a thought-provoking paper. So I can really recommend reading that. I think it's a very nice paper. So let me start with my first set of comments on what I call the curious asymmetry of tails, because the paper doesn't really give us an economic explanation. Why would the left tail be so much more important than the right tail? So I was wondering, is it really an economic fundamental asymmetry? Is there a theory that helps us understand this? Or is it a period-specific effect? Or maybe is it a compositional effect that we have in the data here? So let me first think about the period that the paper analyzes. So they have data from 1983 to 2019. And I just plot very simply here CPI inflation in the United States there. You can see there's a couple of episodes where inflation is pretty low. And we all remember that inflation was close to the, very much below target. We also have a couple of episodes where inflation is somewhat elevated, but it's nothing compared to an extended sample of, say, 1978 to 2025. Now, the Michigan survey data do exist for 1978 to 2025. Now, I understand you didn't want to include the COVID pandemic in there, but still, I wonder, could it be that the sample you have picked basically just doesn't give us enough variation in the right tail? So there's variation in the left tail, but just because of the sample, we really don't get any variation in the right tail that helps us identify this, and that leads to the asymmetry of tails. The other question is it maybe a compositional effect? So Guido already mentioned in his presentation, the people who sort of sit in the left tail it's not a representative consumer. Actually, they run regressions and they find out these are people with high income. And the paper then argues, these are people who matter for macroeconomic outcomes. So I took out the microdata from the Michigan survey, and I just plotted the distributions of high income and low income households. So this is 1 year ahead inflation expectations, bottom quintile versus top quintile. I think this chart is really interesting. It shows a couple of things. So the first thing is the red clearly has a lower mean than the blue. So high income households have a considerably lower mean inflation expectations. But there's also much lower dispersion. So you see the whiskers of the red box plots here are much smaller than those of the blue. In particular, if you go towards the end, which admittedly is not part of your sample, I still thought this is very interesting. Now the red sort of respondents here are also much less likely to be in the upper tail. I mean, just look at the very last set, so 2024, where the red whisker ends. This is basically where the blue whisker just starts, okay? So these low-income households, basically they populate the right tail. The high-income households are much more likely to be part of the left tail. Now, given that the blue is so dispersed, I'm just wondering whether the blue households or the low-income households actually have just a very inferior signal-to-noise ratio, right? So I was wondering, what if you just looked at the high-income households? Not very democratic. That's not what you're after. But if you only include those people who probably have a higher signal-to-noise ratio, would you actually be able to get rid of what I call a curious asymmetry of the tails? So is it a composition effect? Is it a time-specific effect? Or is it really economic fundamentals? Very quickly, the paper doesn't really talk much about the role of uncertainty. And I think this is important. I think it should be discussed because it shows that both shocks that raise the mean and the variance of inflation expectations are stagflationary. Now, we've seen work that tries to disentangle these things. So if you actually run RCTs where you increase the mean of households, the variance also, uncertainty also increases, right? And there's a very nice paper produced by colleagues here at the ECB, which disentangles this and actually shows that raising the mean actually does lead to lower consumption, whereas, leads to higher consumption, whereas raising the uncertainty, which happens simultaneously, actually lowers consumption. So disentangling these two effects, I think would be interesting, at least talk about it. You cannot do it with your data. And then my question would have been, maybe do look at the SPF, which allows you to disentangle mean and uncertainty effects. And the last set of comments are, of course, I couldn't help it, implications for central bank communication. That's sort of my pet topic. So the paper does all of these scenarios. I think it's super cool. So it asks, what if the central bank moves the mean closer to the target? What if it decreases disagreement? Or what if it only targets the tails? So there's various scenarios. It's very elaborate, very well done. And of course, given the importance that's given to the left tail, the paper then, at least in an earlier version, concluded that a central bank should focus its communication on convincing consumers that inflation will not be too low. So basically target the people in the lower tail. Now, granted, I think we all understand central banks should make sure that the left tail does not break away. Central banks are very cognizant of this. Remember, obviously, at the effective lower bound, inflation was below target. Central banks made huge effort to make sure inflation expectations don't fall through the floor. But central banks are equally concerned about the right tail. And again, we've just seen this now in the more recent post-pandemic inflation surge, or the ECB strategy review was all about symmetry. Or in the panel, we've also heard this, we were worried that inflation expectations are unanchoring to the upside. So central banks don't have this asymmetry. And I'm wondering, how should we interpret the statement in the paper? Is this a time series question? So is this central banks should worry more if the entire inflation distribution drops down? Or is it really more a cross-sectional question, like, always target those people who are at the bottom of the distribution? Now, maybe things are not as complicated as you have them in the paper. Again, it's very elegant, but maybe central banks can actually achieve all of this at the same time. If you look at the outcomes of information treatments, typically what they do is not only both, so they, at the same time, they move the mean closer to the target, they decrease disagreement, and they take people out of the tails. So this is an example of a Bundesbank study where you can sort of see the red distribution. You know, people are taken out of the right tail. The whole distribution moves closer to 2%, and the dispersion is much less pronounced. So these things are not separate communication scenarios. With one communication, you can actually achieve all of this. And similarly, paper on the US, Michael Weber is a co-author of that paper, shows the same thing. So not treated households have these inflation expectations on the blue line. As soon as you give them an information treatment, be it the target, be it the central bank forecast, or be it past inflation, you actually in particular reduce the mass in the right tail, but you also reduce mass in the left tail. You move them closer to 2%, and you reduce dispersion. So it seems a magic wand here. They can do all of these scenarios in one go. And looking at this, you know, then I sort of thought, you know, my earlier take coming into this, you know, working on central bank communication for a while, I haven't changed my prior here. I think central banks should focus on the first order importance issues, that is, provide information about the target, and that achieves a lot of the things that you have in mind. Maybe make people better understand, enhance financial literacy and trust. And then if A and B are insufficient, then work on the tails, but in a time series sense. So if the distribution really shifts down or up in a symmetric way, you know, that's something central banks should focus on. I think I'm out of time, right? So I'll skip the other comments, and thank you.
Thank you, Michael. We'll collect a few questions from the floor and then let Guido reply, if that's okay. Jean-Paul.
Thanks. Fascinating paper, Guido. So I'm trying to understand. So, okay, so this stagflationary effect seems to be the same thing that, you know, we learned from Koibion and Gorodnichenko about inflation expectations. And kind of it sounded like, you know, we now know it's there, but at some level, I want to kind of remind us that if that's how the data looks like, we should be, you know, a little bit uncomfortable, because it really is at odds with the standard New Keynesian model. Because if what's going on is that people have these stagflationary beliefs, it means that really what drives inflation is this shocks for which we don't have a good theory, these non-structural shocks. And, you know, that's number one. And number two, if we really think that monetary policy's job is to control inflation expectations, then it means, first of all, it means that, you know, exogenous monetary shocks are not going to move expectations, or agents are not going to really, you know, attribute any inflation movements to monetary policy. And moreover, you know, even the systematic component of monetary policy is not going to have the effects that our model predicts. So that's one. And the second is, so what are your thoughts about that? And the second is, so if I follow, given that effect, it means that a central bank that cares about this lower tail of inflation expectations, and, you know, by communication, let's suppose that tail is below target, and, you know, a central bank wants to increase those inflation expectations. According to the evidence that you show, is going to have, so it's going to raise inflation and it's going to cause a recession, which is not what I thought we were trying to do during the zero lower bound episode, where we were trying to raise inflation expectations to stimulate the economy, right? So just tell me if I'm completely confused, but, you know, it seems to me that from what you showed, that's the way to think about it.
Any other questions? Yeah.
Thank you. So, Guido, I'm wondering whether one reason why you find that surprising, at least to me, result that the macro block does not affect expectations is because both variables in the two blocks, they're in fact readings of an unobserved state, that is the current state of prices. You know, the people in the survey, they observe prices in their daily life, and this is what then at the end of the month plus some weeks is reported in the CPI. And so have you thought about that, or am I wrong?
One.
You talk about the left tail. I am curious to know who are these households. It seems that this left tail is people at zero inflation expectations. And I'm wondering whether these people, they really believe that inflation is below the target. If you think that prices are stable, this is in line with our mandate. It's not clear that you want to push them to believe that it's 2%. Maybe they are already believing that prices are stable.
I will actually follow up a little bit on Erwann's point. So recently, for example, in the New York survey, they found that after the pandemic, there was a large chunk of expectations that were actually in the negative territory. So we know that, in Michigan survey, variance is counter-cyclical. So that there is in recessions, there is the dispersion of inflation expectation goes up quite a bit. But what New York Fed people found is that after high inflation, their consumers actually thought that the price level should return to the previous value and not the inflation. So it was like this mean reversion argument, or that was prevalent in those people that had very low inflation expectations. Yeah. So maybe we'll give you some time to respond to Michael's discussion and to answer this question.
So first of all, thank you very much to everyone for all the comments. So I come back tomorrow. No, I'm just so
How much time do we have?
2 minutes.
So yeah. So let's start with the discussion. Thank you very much, Michael. Lots of comments that we should talk about, think about seriously. So the first thing is why the left tail matters. Extend the sample. That's something we can do. Even though we don't want to take the COVID period for all sorts of problems, we do have actually something I didn't have time to talk about, counterfactuals that we do for particular crisis time, and we do it also for COVID. And we try to identify, we shut off the shocks of inflation expectation, see what would have happened if inflation expectation didn't move exogenously in our framework. Composition effect, only look at high income. That's also something we surely can do. Disentangling the two effects and discussing the role of uncertainty. I think this is exactly what we're doing, right? Because we can move the distribution by just moving the location, just moving the variance, or moving just pieces. So that I think we did. Both tails are important regarding central bank communication, point taken. We're not saying that the right tail is not important at all, even though data seems to be to suggest that are much less important than the left. In the communication counterfactual, we do move also both mu and sigma. You say they do move together very often. We actually have this counterfactual in which we.
Quickly say, I mean, there's within individual uncertainty and there's disagreement, right? So these two things are
So individual
uncertain am I, and the SPF has
on the individual we don't have anything to say, unfortunately, in the sense that the data we have don't even allow us to do it, right? But that's a good point. So Jean-Paul, I think it's true. This is in line with a lot of RCT's results. But RCTs are about individual. Pretend to say that we didn't have any macro evidence, right? And that's at the end of the day should be the ultimate goal, I think, of all this literature. Does it matter for macro? At least that's my, I'm a macroeconomist, and I want to know if that matters for macro. And I think that's, one attempt to go in that direction. So we worried about all these expectational shocks that are floating around, the Baudry-Potier one, the new shocks, or even the sentiment shocks. As policymakers, well, here an idea is that maybe, as Michael was suggesting, this might be due to signal problems, or communication can help actually to discipline at least inflation expectations. I don't know about business cycle shocks.
Marco, about a distribution of latent, I think oil prices, at least, oil prices uncertainty to some extent are there exactly to try to capture some of this, if there is some things that moves the two blocks together. And I think the literature says that gasoline or oil prices are actually the most salient one. We also, I think, try food, no change. Ehrmann is true. I mean, this left tail is basically 0 and 1. I remember these are, they basically say round numbers. So these are basically 0 and 1. Then you say that this is in line with our mandate. I mean, this is Banque de France. How would I say so? I mean, yeah, no, I was joking. But still, I mean, this is you know, you like them to be a bit less. I mean, if you have in mind a kind of Gaussian distribution and more people centered on 2. And to the question about high inflation, the New York Fed, there is, I mean, I don't remember. It was the last one.
It was just about that in recessions.
Yeah, that's I showed the recession.
But they had some extra questions in their survey, and they showed that.
But that's not long enough.
Yeah.
No, if I can, sorry, just again going back to Michael saying, you know, maybe you don't have enough movements of the right tail. Oh, one of your first comment.
Or noisy movements on the right tail, right?
Yes,
because it's the.
But actually, we have crisis, and in this crisis, the right tail do move. So it's not really about having the 70s because inflation is high, but we do have movements to the right tail too in our sample.
But they're not informative.
Yeah, they are not informed. Thank you very much anyway.
Thank you very much.